Many investors treat the market like a puzzle, convinced that consuming enough data will let them accurately forecast the future. They spend hours absorbing financial news and expert predictions. But instead of an edge, this flood of daily noise simply feeds overconfidence and pulls them right into herd behavior. James Montier, a behavioral finance expert, argues that your actual enemy isn't the market, it's yourself. He proposes that successful investing is 30% technique and 70% psychology. This table illustrates the investor's delusion, comparing the promise of what works against the reality of our wealth. The promise claims rapid trading and confirming research guarantee high returns, but the reality is that transaction costs drain capital, and confirming research creates critical blind spots. Chasing the illusion of control gives you a temporary ego boost, but it actively hollows out your long-term portfolio growth. Fixing this requires building a defense system against your own mind. Professional and retail traders alike often fall into a trap of overconfidence. They assume they have the unique ability to get in before the crowd and time their exits perfectly. Because they think they can outsmart the market, they trade excessively. Every unnecessary transaction racks up fees and taxes, reducing potential profits while their actual market timing proves consistently poor. But when the market turns, this aggressive certainty collapses into a completely reactive state, loss aversion. This chart visualizes loss aversion. Human beings experience the pain of losing money twice as intensely as the pleasure of making the same amount. Driven by this disproportionate pain, investors hold on to losing stocks far too long, while selling winning stocks early. The math of this behavior is simple. You end up curating a portfolio filled with stagnant assets, while deliberately capping the upside of your best performers. You make a direct trade. You take action to temporarily soothe the emotional pain of a loss, and in exchange, you handicap the long-term compounding power of your capital. This psychological fragility also corrupts how we research. We are naturally prone to confirmatory bias, meaning we seek out information that agrees with our existing views. An investor spends heavy research hours, hunting down specific articles, seeking out expert opinions to validate what they already own. Ignoring warning signs to protect your original thesis is like navigating dense fog with only a dim flashlight. This selective research method creates blind spots. By filtering out contrary data, the portfolio is left exposed to unforeseen losses. To defend against this, you have to adopt a habit of actively seeking out the bear case. You must search for the specific evidence that would prove your own analysis wrong. Forcing yourself to process opposing data breaks the grip of the sunk cost fallacy. It stops you from clinging to a bad position simply because you spent time and effort developing it. Confirming research protects your ego in the short term, but intentionally questioning your own analysis by searching for disconfirming evidence increases your portfolio's actual resilience. To survive market volatility, you need to rely on a cold state process. This is the structural barrier that stops both overconfidence and loss aversion before they start. This flowchart tracks a stock dropping 15%, branching into two paths. In the reactive state, processing the drop in real time triggers panic, forcing loss aversion or herd selling. But in the pre-committed branch, the investor executes a predefined rule, bypassing emotions entirely. For this system to work, there is one requirement. Your rules for buying, holding, and selling must be established when the markets are quiet and you are in a rational state. You are making a calculated trade. You give up the daily thrill of active investing, and in return, you gain a process that prevents emotions from overriding your financial strategy. Shifting from predicting the future to building rigid processes allows the investor to focus on variables they can actually control. This effort versus impact quadrant maps out the mathematical reality of common investing behaviors. Look at the high-effort negative impact quadrant. Tasks like forecasting daily movements, day trading, and hunting for confirming news consume time while reducing your yield. Compare that to the high-effort, high-impact quadrant. Building a cold state process, practicing critical contrarianism, and auditing your past decisions takes work, but these inputs drive positive returns. The traditional financial hustle often yields a negative return on investment. True optimization requires you to do less of the wrong work. If you are an anxious novice prone to checking the market daily, you need structural distance. Defeat loss aversion by setting pre-committed rules and automating your contributions. Then ignore daily financial news and stop checking your portfolio balance. Let the math work. If you are an analytical optimizer who builds elaborate market spreadsheets, your modeling may be masking your biases. Combat self-attribution bias by stopping your predictive modeling. Redirect that energy backward. Audit your past decisions to cross-reference them with outcomes and separate luck from skill. Contrarian investing requires betting against the crowd, but also betting against your own psychological impulses. By identifying yourself as the primary threat to your returns, you can step out of the way and let your process build long-term wealth.